Um, so today we're going to be talking about financial statements in chapter 15, and then we're going to talk about business statistics and just trying to find the medium, the mean, the mode, the range, etc., of a set of numbers or a set of data. But financial statements are important, and there's three primary financial statements in business that every business uses. Of course, that's the balance sheet, the income statement, and the statement of cash flows. We don't get into the statement of cash flows in this chapter, just the first two, the balance sheet and the income statement. The statement of cash flows is very valuable, though, because it helps you plan and predict how much cash you're going to have on hand. And as the saying goes, cash is king, right? If you run out of cash, you could have millions of dollars of assets, but no cash, and you're going to go out of business. So you definitely need to have cash. You need to be able to pay your creditors. You need to be able to pay your employees. You need to be able to pay your rent, and you need cash to do that in. So if you run out of cash, you're in trouble. So that's why that's why you have a statement of cash flows, because it helps you to predict and plan how much cash you're going to have on hand from various resources. But for this class and for what we're going to be working on in this chapter, it's dealing specifically with the balance sheet and the income statement. And these are two documents that you'll become very familiar with if you take accounting, because this is where you're going to be doing a lot of your you're building all of the data that goes into these two tables. And fortunately, today we have QuickBooks, and I don't even know why we teach the old-fashioned accounting, because nobody knows how to do it anymore anyway. You don't need to know how to do it in the real workforce. You just need to know how to use QuickBooks, which does it all for you. So you input the data, and you can print out your balance sheet. You can print out your income statement right out of QuickBooks. But to describe the difference between the two, in case you don't know, the balance sheet basically shows at any moment in time how much you own and how much you owe. So it's your assets and your liabilities, and then owner's equity. So it's all of your assets. It's cash, it's accounts receivable, that's considered valuable. It's everything from your logo, your building you own or are purchasing, all the inventory you have sitting around, prepaid inventory, prepaid insurance, etc. All that's your assets. It's all those things that are of value to you, and it's what you own, OWN. Your liabilities are everything that you owe. So it could be loans, it could be salaries that you need to pay, it could be rent on your building, it could be utilities, etc. It could be accounts payable, things that you still owe people for. And then that's the liabilities. And then you have owner's equity. Whatever's really left over of those two is really what you own as the owner, or what you've invested as the owner. And that constantly changes, because if you have more liabilities, then that means you have less owner's equity. If you have a lot more assets and you have a lower debts, that means you have more owner's equity. So as an owner of the business, your owner's equity is constantly fluctuating based on how much you owe or how much you own. And so that's why owner's equity is added to your liabilities, because it comes out of your assets. But your assets is a total of everything you own, and then your liabilities is what you owe, and then your owner's equity is really what's left over, as I mentioned. So the formula you see on your screen really is the what they call the accounting formula, and it really kind of says everything. And if any of you've taken accounting, they do what's called a double entry accounting. And what that means is that whatever you do on one side of the equal sign has to be equally responded to on the other side of the equal sign. So of course, if you spend money on your asset side, your cash goes down, but also say you spend money on and you buy something, say some new equipment, well, then your assets cash goes down, but then your assets equal amount of value of whatever you bought goes up. So there's no change. You've changed it in one category, but you've also added it in another category. However, if you pay money out to pay salaries, well, then your liabilities are going to go down, and so is your cash going to go down. And so those two things kind of go in tandem. And the key here is at any moment in time, when you take a snapshot of your balance sheet, it should always equal. Your assets should always equal your liabilities plus your owner's equity. And if something doesn't equal, that means you didn't calculate something correctly. And that's the whole purpose of it. It's like a double check system to make sure everything is accurate at any one moment in time. So that's what the balance sheet does. Some of the values you take off the balance sheet are used in what we call the ratios, and those ratios are used to balance or gauge the health of the business. And so that's why the information being input properly and being accurate in your balance sheet is extremely important to really gauging the overall health and value of your business, especially if you want to sell it, or especially if you want to get a loan of some sort. You need to make sure that all that stuff's accurate. Your income statement, on the other hand, is basically a snapshot of your business over a period of time. So it could be a month, it could be a quarter, it could be a year, and it shows you how much you've earned in revenue or sales, how much it costs you to earn those sales, and then all of your fixed expenses like your rent and your operational costs and all that kind of stuff. And basically, you take everything you've earned in a certain period of time, everything you've spent in a certain period of time, and then at the bottom line is, did you make money or did you lose money? And that's what the income statement shows. What income came in, what income went out, and how much do you have left? And did you make money or did you lose money? And that's why the income statement is also known as the P&L, or profit and loss statement, because it will show you whether you've made money or lost money over the period of time in which you are evaluating it. Most companies do it quarterly or yearly, that they'll run an income statement, but you could do it at any point in time. You could do it, the business that I have is a church, so I could run right now an income statement from last year this date to this year this date, and that would give me everything I've brought in and everything I've spent, and it would tell me whether I've lost or made money, or was profitable. In my case, I'm a nonprofit, so it would be whether or not I've have more money coming in than going out ultimately. So that's the two statements. And so we're going to be looking at how to do, how to make them up based off of the data that we have. We're going to be talking about analyzing them with vertical analysis, which is comparing certain categories of your assets, or certain categories of your liabilities, or certain categories of your cost of goods sold, or certain categories of your operational expenses to your overall assets, or to your overall liabilities, or to your overall income, or to your overall revenues, etc. So we do the analysis to see, if anything's changed or anything is out of ordinary when we do a vertical analysis, and then we also do horizontal analysis, which is basically comparing last year to this year at this point in time, and how much has it changed, and do we have more liabilities now than we had last year? Do we have more assets now than we had last year? Do we make more money last year in revenues, but then we actually spent more money in expenses? So it tells you all that information when you look at it horizontally. And so we'll be looking at both of those as we go through this week's work. So any questions before I move into kind of what we're going to do? We're going to look first at putting together a balance sheet. So any questions? All right, the first thing I want to do is just take a quick look at a balance sheet. And this is hypothetical enterprise. It's a balance sheet for December 31st. But I want you to notice you have assets right here, and then it lists everything that are your assets to where you have total assets. And then you have liabilities and owner's equity. And so you have your current liabilities, your long-term liabilities, and then everything that remains is your owner's equity. That's basically their stock, retained earnings from the year before, etc. So this is what we could call a balance sheet. And I want you to notice the total assets are $341,300. And what are the total liabilities and stockholders' equity? The same, right? So that means this company is balanced. Everything has been done, it seems, appropriately as far as inputting all of their information. And everything has been double entried, so that way everything is balanced at any one moment of time. And so if you look here, you can see their current assets. They have cash. And so they have current assets, and then they have what's called property, plant, and equipment. That area is stuff that's long-term assets like land, buildings. So you can see here in current assets, you have cash. That's obviously the most current asset and most liquid. You have it. You don't have to do anything with it. You have accounts receivable. That's money that people owe you. So it's basically it's valuable to you because they owe, even though you don't have it yet, they owe it to you. So that's essentially an asset. Then you have merchandise inventory. So anything you have in your inventory, whether that's supplies or whether that's finished goods, either way, it's got value to it. So there's a dollar value on that. And that's why we were doing the different inventory methods, because the different inventory methods either show more or less value of your inventory. And then you have, in this case, prepaid expenses. So maybe they paid some insurance or they paid something for the whole year, but it's prepaid. So it's considered an asset because it's not going to be taken out of their cash any longer. It'll just be decreasing as time goes by. And then you have your supplies. So the same thing. Maybe those are, things like materials, raw materials, pencils, papers, ink, whatever you use in your business. So all of those items we call current assets. They're all current because they're things that you could get rid of within the next few months or next year or so. Long-term assets like property, plant, and equipment, land, buildings, machinery, equipment, etc. These are the items that you are either appreciating or depreciating. Like, for instance, machinery and equipment, we did depreciation last week. And so those items are on your balance sheet, but they're under property, plant, and equipment. Those are long-term assets. And they all will either appreciate in value or depreciate depending on what they are. And then there's also what we call investments. So some companies in their assets, they've made investments into other companies or stocks of other businesses or whatever else. And so that's worth money, right? That's valuable. They could sell that and they could get the cash back on that. So all those things added up, even your logo and things like that could have a cash value to it and be considered an asset, especially if you have a strong brand. So all that together comes out to total assets. That's everything I own. And it's all put a dollar value to it. And if you notice in these categories, these are all totaled up here, current assets, and you can see the total is 101,300. You guys can see my screen, correct? Just want to make sure. Are you guys following me?
Yes, Professor.
Okay. And then if you notice here on plant, property, and equipment, you have all those added up and they come out to 225. And then in your investments, you have another 15,000. So that's all added up to the 341,300. Now on the liability side, these are your current liabilities. Current liabilities mean things that are due within the next month to the next year. And so in this case, you have accounts payable. Those are things that you own or that you owe, that you still have to pay the people for. So maybe you ordered some equipment or you ordered some paper or supplies and you haven't paid for it yet, but you owe it. And so that's considered an accounts payable. Then salaries payable, that's accumulated salaries maybe over the month of people that you owe money to because they've worked. And so that would be there as well. Then taxes payable. So, most companies put away a certain percentage towards taxes and they know roughly from the year before what their taxes are going to be. So all those are things that are going to be paid within the next year. And so that's what we call current liabilities. And those are all added up and they come out to 29,400. Then you have long-term liabilities, things like your mortgage payment. In this case, there's a debentured road, a bond. Oh, they have some kind of a bond that they took out that they owe back. And so all that's their long-term liabilities. So you add your current and long-term liabilities, and that comes to total liabilities, which in this case is 164,400. And then what's left is your stock owner's equity. That's you as the owner, what portion you own of the company as well. And so in this case, it's capital stock. So maybe you own those stocks and that's what they're worth right now. You also have retained earnings. That's money that maybe you made last year that you've rolled over into your equity. You haven't used it yet. So that the 50,000 maybe of that cash above is your returned earnings that you have set aside. And you might decide to use it to expand your business or buy more stocks or whatever you might want to do with it. So your total stock owner's equity is 176,000. You add that to the total liabilities, and that comes out to 341,300. So when it comes to making then a balance sheet, I'm going to go ahead and share this screen now. And hold on a second. So I'm going to share this screen. And I'm going to go ahead and all right, so we're going to create a balance sheet off of this information here. I apologize because I found my iPen, thank God, but I left it at home today. So it's going to be a little bit of a challenge to create this balance sheet. So bear with me. I might just abbreviate some things just to make it a little more tangible and easy to follow along. But this is for a company named Keystone Auto Repair, and we're going to put together a balance sheet for them. And so it gives us all the information that we're going to need to create the balance sheet. And so basically what this is going to look like again is to just make it as easy as we can. We're going to do assets at the top. So I'm just going to call it assets. I'm going to do liabilities, and I'm going to do owner's equity. So those are the three sections that we're going to have. And I'm going to divide them. And we'll do totals here. Anyway, so under assets, we have current assets, CA. And our current assets, according to this, are cash. So we have cash. We also have accounts receivable. That's money I still need to collect. So I'm going to do accounts receivable, AR, if you guys are okay with that. Then I have inventory. That's inventory is going to be something that's worth the current assets. I have prepaid salary. So I'm going to see if I can write that, prepaid salary. And then I have supplies. I'm not going to be able to fit all this, so. And it doesn't like my S. Sorry about that. Just going to do supplies. There we go. So I have a value on each of these, right? That's a lot. So I have, for my cash, I have 5,200. For my, that's cash. For my accounts receivable, I have 2,800. For my inventory, I have 2,700. And then for my prepaid salary, I have $235. And then for my supplies, I have 3,900. So I'm going to add all those up, and they come out to 14,835. So those are my current assets. Remember, I said those are my current assets. And I'm just going to put it over here because I don't have any room. I'm going to do my long-term assets, which are what we call property, plant, and equipment, PP&Es. And in that case, we have a land of 35,000. So land, 35,000. I'm just going to put 35K. Then we have building of 74K. And then I have fixtures of how much? 1,200. And then I have a tow truck. There's a lot on here. Tow truck for 33,600. And then I have equipment. Let's put equipment of $45,000. All right, if I add all that up, those are my long-term assets. That's going to come out to 188,800. And then if I add those two together, it's going to come out to $203,635. So that is my total assets, TA. You guys with me on that?
Yes, sir.
So you'd probably want to do this all linear, not side by side like I'm doing it, but we'll just go with it. And then my liabilities, if I continue on, I have accounts payable. That means money I owe. So accounts, this is going to be current liabilities. And I have accounts payable. I owe 6,800. And then I also have notes payable. That's very similar to a bond. So that's 17,600. And then I have a mortgage payment. So I'll just put it as mortgage. And that one is how much? 51,000. And that's it. So those are all my liabilities. If I add all of those up, they come out to, actually, I should have broken it down. The short terms are here, and then this is the mortgage is long-term liability. So these two equal 27,940. And then this is 51,000 plus 51,000. So my total liabilities equals 78,900. And then my owner's equity, fortunately, we only have one category there, right? So it's really what remains of the 203,635 of my total assets minus the 78,900. But to just make it simple, it comes out to $124,695, and we're told that at the top here on the problem, right? So we would just add those two together. So add the total liabilities with the owner's equity, and it's going to come out to 203,635. And that's kind of how it's done. So you just need to take that information and you need to put it into a balance sheet with assets, liabilities, and owner's equity. I'll show you again. I'm going to stop sharing my screen, and I'm going to go back to this here as an example. And I think this particular problem it might be in the PowerPoint like last week. If not, oh, session has expired. That's weird. Okay. Let me go back to the ebook. So I just want to show you this. This is going to give you the answer here. Oh, and it's not going to show up. Why isn't it doing that? I'm going to download the image. I'm going to open the image. All right. You guys probably can't see my screen, so I'm going to reshare. All right. So here it is. Here's the way it should have been written out compared to what I did. Current assets, so you have cash, you have everything here. Total current assets was 14,835, which is what I had there. And then you have your plant, property, equipment. I listed all those. Total on that was 188,800. Total of 203,635 for my total assets. And then I did liabilities and owner's equity. I added up the accounts payable, the notes payable, and the tax. Oh, I didn't see taxes. I skipped that, didn't I? Anyway, that was 27,900, and then I added the 51,000 for the mortgage they had. So my total liabilities was 78,940, and then I added the owner's equity of 124,695, and that came out to 203,635. But this brings up a good point. Is I missed the. Did I miss something? Taxes. I missed these taxes payable. And that's the thing that most students do as well, is when you're working on these problems, you end up many times missing what it says. And I just gave a good example of that in my thing here. Let me go back to that for a second. Oh gosh, this thing is really being a bear today. So let me share my screen. Okay, I want to go here. I want to go here. I just want to show you back to the screen. So notice the taxes were where? Right here. I missed this taxes payable. Oh, you guys can't see my screen, can you? You guys aren't seeing my screen?
I cannot see your screen.
Just give me a second. Shoot, I didn't want to do that. So I wanted you guys to see right here, taxes payable. I missed that in my calculation. So it's really good to kind of list them all out in maybe a list before you start building your balance sheet. But that's kind of what you want to do. So I did it for you as best I could with using my finger as a pen, because again, I left my iPen at home, and I apologize for that. I think what I'm going to do for the horizontal analysis, which is the next problem on here, is I'm just going to go to the book to show you how it's done. And hopefully you've already looked at this, but I'm not going to work it out other than I'll show you how to do one of the calculations on it. So let me share my screen here and go back to the book. And I'm going to go ahead and just move ahead to the next page. Hopefully you've already looked at all this, but gosh, that's really bad, isn't it? See if I can zoom in. All you're going to want to do on the horizontal and vertical analysis.
We have a PowerPoint slide 18 on vertical analysis.
You do? Okay.
Yeah.
Should I go there?
Yeah, it's a PowerPoint slide 18 on the chapter 15.
All right, hold on. So I apologize. I'm not going to work through the vertical analysis, but I am going to show you how it works. And basically what you're going to do, and it's a little bit different for the income statement as it is for the balance sheet. But on the balance sheet, you're going to deal with all of your totals. So for instance, this is the top half of the balance sheet. You have the assets here, and then you have total assets. So you're going to try and figure out what is the percentage of each of these assets to your total assets. That's what you're going to try and find out. So that's 100%, right? So everything you're going to divide by is going to be divided by this number right here, this 341, because that's your total assets. So all you need to do to figure out your various percentages of each of these assets compared in relationship to your total assets is you're basically just going to divide the number of for instance, the cash by the 341,300. So if you do the math on that, you'll find that it comes out to 0.038 or 0.0375 or whatever. And so you're going to round that to 3.8%. So basically the cash then is 3.8% of your total assets. How about accounts receivable? We owe we have $32,500 coming to us from our people who bought stuff from us. So how much is that percentage of that to the total assets? Well, it's 9.5. I divide 32.5 by 341,300 and give me 0.095 or 0.0946 or whatever, and I round that to 9.5%. So that's all you do with vertical analysis, but the key is that you need to make sure that you're basing it off of a total. And in this case, the total is your total assets. You guys see my screen, right? I'm not talking to blank screen.
We can see it.
Okay. So you go down to the other half. Now, this is the bottom half of the income state or the balance sheet. You have your liabilities and stock owners' equity. So here, same thing, but it's based off of the total liabilities and stockholders' equity. So that's your 100%. So again, the 341,300. So whenever you're doing it for a balance sheet, you're always doing it off of the total assets or the total liabilities and stock owners' equity. Now, that doesn't mean, however, that you couldn't take it off of just your liabilities. So for instance, where the 164.4 is, you might go, hey, I want to find out what, I don't really care about the stockholders' equity. I just want to find out what is my percentage of each of my liabilities to my total liabilities. And then you would make the 164.4 the 100%, and you divide everything by that. But in this case, and for the purposes of this class, they're pretty much going to ask you just to use the total liabilities and stockholders' equity. So again, you would take your accounts payable, that's money you owe other people, that's 17,500. You divide that by the 341,300 of your total liabilities, and that means that accounts payable is 5.1% of your total liabilities and stockholders' equity. And so you just go right down the list, dividing every one of these numbers by the total. And that would give you your percentage. And of course, if you divide 341,300 by 341,300, what do you get? 100%, right? So that's pretty much how you do the vertical analysis. So the horizontal analysis is a little more interesting, and it's not difficult. I'm not going to show you that either. I'm just going to explain it. Oops, I'm going to explain it on, I'm going to explain it the same way I just did that, just for the sake of time. And am I? Yeah. So let me go back to the PowerPoint. I apologize, I closed out. This is probably going to be on
slide 21.
Yeah, so here's a horizontal analysis, and all you're doing in a horizontal analysis is you're comparing one year to the year prior. And so be careful, because sometimes the dates, they'll put the most current date first and the older date second. So the older date to the right is, or the newest date is to the right. And sometimes they put the newest date to the left, but you'll see here when I show you. But all you're going to do here is you're going to find the difference between the 2 years, and then you're going to divide it by the original year. And so you're going to take the amount of change by the previous year. Remember, we were figuring out percentages and we were figuring out portions. That's exactly how we found the rate. We took the portion and divided it by the base, and that gave us the rate. And so you're doing the same thing here, is you're going to take your year. In this case, you can see my screen, right? 2016, 2015. You guys see that?
Yes.
So notice 2016 is the most current date. 2015 was the year prior, but you're going to divide everything by the year prior. So for instance, you're going to take 3,500 and you're going to minus 2,900. That means there was a $600 difference between the two. And you're going to divide that $600 difference by the 13,780. So let me double check that. 600 divided by 13,780, because that was the original year, comes out to, oops, did I do it wrong? So it's 600 divided by, oh, I'm sorry, it's going to be by 2,900. It's going to be this year right here. 2,900, that was the original amount for the year, and that comes up. Sorry, one more time. I multiplied it. 600 divided by 2,900, because that was 2015. That comes out to 20.68%. So 20.7%. So remember, you're going to always divide the difference between the original amount. In this case, the original amount is everything in 2015, because you're comparing 2015 to 2016. So make sure you divide it by the first year, and then that's going to show you the percentage of change. So you saw a 20.7% change between 2015 and 2016, and it was a positive $600. Now, how do I know it's positive? Because I can just look and see 3,500, right, is more than 2,900. So that means it went up. If you look at the next one, so now we're looking at 12,450 minus 7,680 leaves us with 4,770. So if I take 4,770 and I divide it by the 7,680, that's going to give me 62.1%. So we saw a 62.1% change between 2015 and 2016, and that was an increase. Then look at the next one. This is another example of the opposite way. So now we have 3,200 in 2015, but we only had 2,140 in 2016. So again, I'm gonna subtract the lower number from the higher number, and that's going to give me a negative in this case. And by the way, whenever it's in parentheses, it means it's a negative number or lower. It's going to be 1,060. But again, I'm just going to divide that 1,060 divided by the original amount of 3,200 equals 33.1%, but it's a decrease because it went down from between 2015 2016. So it's a 33% decrease between the 2 years. So all you're doing is going across each one all the way down until you do both your assets, as you can see on the screen now. And then if I scroll down, you can see your liabilities. Same thing. You're doing the exact same thing. How much change between the 2 years? So you guys with me on that? And notice if you do the total assets last year in 2016 with this year, it comes out to 8,001. It's 3.8%. If you come down here, do the same thing on total liabilities. You have the same thing, 8,110 at a 3.8% change between the 2 years. So that's all you do in horizontal analysis is you subtract the difference and then divide by the original amount. And that's I think a lot easier than the others. So, all right, so that's looking at balance sheet. All right, now we're going to take a brief look at an income statement. And here is a sample example of an income statement for hypothetical industries. And if you notice, it's also broken into some main sections. There's really 2 primary sections. The top part, well, 3 actually. You have revenue, you have cost of goods sold, and I'll explain that. And then that leads you to your gross margin. And then you have all of your operating or fixed expenses. And then you have a total operating expense. And then you have to subtract those 2 from one another. And that's going to give you, you're going to have to subtract all your cost of goods sold from your revenue, and then all of your operating expenses also from the remaining balance. And that's going to give you your total income before taxes. And then if you have income tax on there, you got to take that out. and then that gives you your net income. So in this case, this company, did they have a loss or did they have a profit?
They had a profit.
They had a profit of 91,268, right? So let's go to the top of the chart here for a second. You have revenue, gross sales. So that's all the sales. That's gross sales. That means that's not minusing any expenses yet, just total sales, total revenue. Minus, in this case, returns and allowances, because people do bring things back, right? Things get lost, things get stolen, etc. So in this case, they actually determined that loss or those returns that they, even though they resulted in sales, they have to be taken back out, right? Because they were brought back to the store, they were returned. So in this case, it was $22,875 worth of returns, and there was some discounts that they gave as well. So all in all, their net sales after they removed the returns, allowances, and discounts from their gross sales comes to $896,944. So that's what you might call their net sales, or their, their revenue after all of their returns and discounts. All right. Then you take that amount and you need to minus from it your cost of goods sold. Now, cost of goods sold is what you spent in order to make that money. Like, what did you spend is for all of the material that you sold, or all the stuff that you bought and resold. So your merchandise inventory has to come out of that, whatever you have remaining in your inventory. Whatever purchases you've made has to come out of that. So maybe you bought like some supplies, maybe you bought some materials, maybe you bought some raw materials, etc. All that has to be taken out of the revenue. Freight in, so what it costs you to ship the items and ship the products. Then your cost goods available for sale is the total of all those things. And then you have to minus your merchandise inventory at the end of that period. So that comes out to a total, after you have add all those up, 578, 100, and then you minus the merchandise inventory that you still have remaining at the end of that period, and that comes out to 88,560. So you minus that from the 570 because you still have that as an asset, and that comes out to cost of goods sold at 481,540, and you have to subtract that from your net sales. So that gives you a gross margin, or a remaining balance, of $415,404, meaning that of the $923,000 and $444 that you made in gross sales, you've now eliminated $481,540 in expenses, just making that product, getting it shipped, etc. So now your total, money that you've made is $415,404. Feeling pretty good until now you have all your operating expenses. So salaries, rent, any advertising or marketing you've done, maybe insurance you had to pay, all your administrative expenses, depreciation on items that were depreciated, some equipment or whatever, and then miscellaneous expenses. And all of that stuff adds up to $305,527. That gets deducted from the gross margin. So now income that you actually made after all of your expenses is $109,877, right? And that's before taxes. So now you have to take out your income tax on that, and that's $18,609. So that means that your net income at the end of the period, in this case, January 1 to December 31st, you made after all that, you paid everybody's salary and everything else, you made $91,268. So you made $100,000 in profit. Now you might say, well, that's not very good, especially when you made almost $1 million in gross sales, but it's not bad. I mean, $100,000, what are you going to do with it? Well, you could go on, if you're a sole proprietor, you can go on vacation, take a nice vacation. You can buy a new house, or put a down payment on a house, buy a new car, or you could put it right back into your business and try and build even more, maybe produce more of the product, or hire more people to help your business grow, buy a new, rent a new building, whatever. Or you can retain it just as earnings and keep it in there for a rainy day. That would be called retained earnings, and it goes right under the owner's equity portion of the balance sheet. But either way, that's what an income statement looks like. So you're going to make one of those. So you're going to do the same thing. So if I go back to my other screen, so let me see if I can do this. Hold on. I'm going to share my screen. There we go. Share my screen. I'm going to start broadcasting and I'm going to open. I'm going to go ahead and open this to the next page. Let's see. It's the one for the income statement right here. All right, so now we're looking at the problem. Can you guys see my screen?
Yes, sir.
It says income statement at the top, and then it has all the information. Okay, so the same thing. I'm gonna abbreviate as best I can. Use my finger here to write this out. But this is cutting edge manufacturing for the year ending December 31st. They had gross sales. Okay, so let's put GS, gross sales of $1,356,000. And then they had returns and sales and allowances. So we're going to minus of 93,100. And they had discounts of 4,268. So we're going to call this returns and discounts. So we're going to subtract these two from that total amount. And I already have the math done over here, so I'm just going to look it up. What was this one? Cutting edge. Okay. So cutting edge. So that ends up being a new what we call net sales. Is that what it was? Net sales of 1 million. Sorry. $1,258,632. And then we're gonna, so that's gross sales to net sales. You can draw a line there. Now, the next thing we're gonna figure out is the cost of goods sold. So we'll just call it it's often called COGS and cost of goods sold. So that's gonna be starting with merchandise inventory on January 1st. So we'll do inventory. It's really starting inventory, and that's gonna be for how much? 324,800. And then we have what else? Merchandise inventory December 31st of 179,000. So we'll do ending inventory.
We have to add purchases, right?
Oh, did I miss purchases?
Yeah, net purchases and freight in. We have net purchases 255,320.
Oh, that's what I missed. Well, no, I have merchandise inventory in December, but I'm going to do that last. So, all right, hold on a second. So I'm going to do purchases in here. That's going to be P. I'm going in order. So I had inventory on January 1st, and I had merchandise inventory December 31st. So I wrote that lower down here, ending inventory, which was 179,100. And then I had purchases of, gosh, I'm having a hard time looking at this. 255,320. You guys with me? And then I also had freight in. So we'll just do freight. Sorry, I'm abbreviating. And that's going to be for 3,900. Gosh, I can't squeeze it in here. $11. And then we have one more. Let me just move this. Sorry. Then we have one more, which is salaries. And that's going to come out to 375,900. All right. Oh, actually, salaries.
Salaries come in
Salaries,
operating
sorry.
expenses, right?
No, you're right. That's operating expense. Sorry. So I could have just left it the way that it was. Then we have ending inventory, which I already wrote in there, was 179,100. So that's going to be value. So basically, I'm going to add all these up. Sorry. I'll add that in a second. So I add all those up, and it comes out to 584,000. and $31. And then I have to add my ending or deduct my ending inventory from that. So my ending inventory was 179,100. Is that right? Yeah. So now that gives me a total cost of goods sold at 404,931. So that's my total cost of goods sold. Now, again, my net sales is here. So I have to deduct my total cost of goods sold from that, 404,931 from 1,258,632. That gives me a total now of 853,701. So that is what we call now our gross margin. Now I have to, unfortunately, if you can write down the 853,701, I got to continue down here, but unfortunately, I can't continue down here because there's no room. So I'm going to have to.
I had a question here, Professor. So gross margin, gross profit.
All right, so I picked up here. I'm going to do the second part of this income statement. So I have what's called our gross profit margin. Now I'm going to look at my operating expenses, OE. My operating expenses are salaries, right? So salaries of 375,900. And then I have rent of 166. And then I also have utilities. This is just not working. My finger's not. 7,730. Advertising comes out to 73,300. Insurance comes out to 222,940. And then administrative expenses, so add administrative expenses, AE 84,500. And then miscellaneous expenses, ME comes out to 24,900. So I'm going to add all those up, and they're all going to come out to total operating expense 755,270. So that's my total operating expense. Now, of course, that needs to be deducted from my gross profit. So my that's going to leave me with a $98,431 net profit before taxes. So income before taxes. And then I have my taxes, which are mentioned right there, right? So what's my taxes? 34,000 minus 34,760 gives me a net income of a whopping $63,671. So this is the second half of the income statement, that basically this is what you need to do. So it's going to be, the problems are going to be like this, and they're going to be exactly in the order like I just did it. You just need to know where to stop. And in this case, I put taxes at the end, but remember I started to write payroll, right? Salaries into the other one. And that needs to go under operating expenses. So all you need to do is go look at the income statements, and you'll know exactly where to put it. All right, so here is the way it should have looked. It's right out of your book. So again, we had our gross sales. We took out our returns and our discounts. So that gave us the 1,258,632. Then we did our beginning inventory, our net purchases, our freight in, our goods available for sale. We totaled all those up. And then we subtracted, or we subtracted the existing remaining merchandise and ending inventory from that, because even though I had inventory at the beginning of the time, I still have some at the end that's still there. So there's no expense to that, right? It's actually considered an asset. So that has to be subtracted from all of these expenses, my cost of goods sold. So that came out to now 431 of total cost of goods sold, and I subtracted that from the 1,258,632, that gave me a $853,701 gross margin, or gross income. I think you can use either word interchangeably there. However, I still have my operating expenses to remove, so I have to add all those up, which I did, and that gave me a total operating expense of $755,270. I minus that from my gross margin or my gross income, and now that gave me income before taxes of $98,431. I had to take my income tax. Notice how high the income tax is. That's because it's based off of the larger amounts. And then it gave me a total net income of $63,671. That is a profit. So over the year, I made a profit, but my profit was only $63,671, and I made almost 1.5 million in gross sales. So but then again, salaries were paid. People were bought my product and they were enjoying it. So I mean, life happened and the business did grow a little bit. And I could take that 63,000, I could reinvest it in my business. I could go on a nice vacation. I can buy a car, put a down payment on a house, or I can roll it into my own assets in the company. And that would be considered owner's equity and retained earnings is what we call it. So anyway, so looking at that, then we do the same thing with we did on the balance sheet. We do the same thing on the income statement when it comes to vertical and horizontal analysis. So unfortunately, because I can't draw on my pad, I'm going to go ahead and just go to the ebook on this. And or not the ebook, but the PowerPoint slides. So that's really where I really wanted to go. Let me delete all this. Getting a lot here. So let's go to modules. Go to this week, and we're going to go back to the PowerPoint slides, and I'll show you the difference between doing it on a balance sheet versus doing it on an income statement. So
Slide 33.
Okay, so slide 33. Yeah, that's just showing you how to do it. All right, so here's a vertical analysis. And vertical analysis, if you notice, they're dividing it by category. So for instance, revenue, they want to compare, in this case, net sales to revenue. So they want to figure out, how much of our what percentage of our gross sales is net sales, and then how much of our, what percentage of returns did we get? What percentage of discounts did we give? And so they're basing that all off of net sales. So obviously your gross sales are going to be higher than your net sales, right? So you might even look at that and go, well, gosh, last month our gross sales were 101% of our revenue, but now it's 103, like it's gotten worse, so we need to keep track of that. And so that's one reason to do it. So when you're doing revenue, you want to base it off of the net sales. And then as you go down in your income statement, I think everything is based off of that amount, the net sales. Does that make sense? Everything is based off of net sales. So if you take, so cost of goods sold, so how much merchandise inventory off of that amount. So is that correct if I do the math on that? And I didn't record any of that, so I'm just going to say it again real quick. So on the income statement, you're basing everything for your vertical analysis off of net sales. So all you're going to do is divide every one of these by the total net sales. And that's going to give you the percentage. And again, the benefit of that is you're able to compare, percentages within certain categories. So if you have freight in versus net purchases, you might say, well, my freight in, it was 1.4% of my net sales this time, but it's a lot higher, but my purchases were lower. What gives? So it gives you a chance to kind of gauge the health. And so everything is going to be gauged by that net sales. And you're basically going to divide each of these numbers by net sales to get the percentage. And then on the horizontal analysis, you're going to basically do exactly like we did on the balance sheet. You're going to take the difference between the 2 years, take that difference and divide it by the original year, in this case, 2015. And that's going to give you your percentage of change, whether it be up like it here in gross sales, it's up 3.9%, but in returns, you actually went down in 2016. So you saw a 9.7% decrease in returns, which, you might say, well, hey, how come we saw that? I'm not sure. Let's check into it. And then you start looking at your processes in the business to see why did you have so many returns the year before? Why did you have so few this year? Anyway, so it gives you the chance to compare year over year. And like I said, banks will want this information and they'll run these kind of analyses to give you a loan or not, or whether or not you're going to sell the business. When they value the business, they're going to look at this kind of stuff. And that's going to help them to determine whether you're healthy or not. So that's pretty much it for the two statements that you're going to be doing. And now we get into financial ratios. And ratios basically tell you, again, they're taking information off the balance sheet or the income statement or both, and they're running these calculations, and these calculations tell you something about the company. So liquidity ratios tell how well a company can pay off its short-term debts. So in other words, I have these assets, I have short-term assets, cash, accounts receivable, supplies, etc. Well, if I needed cash fast, how quickly can I pay off my debts with what I have in my assets? So that's what we call liquidity ratios, like how quickly can I do that? And that might be, if you can't do it quickly, you might be in a very dangerous place financially. You might be over leveraged, right? You heard that term. And that's why there's a leverage ratio right there. Show how or to what degree a company has financed its assets. So how much do I owe other people of what I own right now? So I have a bunch of things I'm showing as assets, but I also owe for a lot of those assets. And so my leverage ratio might be really high. And if that's the case, I'm not healthy, right? Because if tomorrow all of my debtors said, hey, we want our money, I'm not going to be able to pay them. And then I'm not in a good place. So all these are used for that. Liquidity ratios, again, how a company can pay off its short-term debts, how fast or how well. Efficiency ratios, how effectively a company uses its resource to make money. So I have assets. So how much, what percentage of my assets, or how much is my return on those assets producing for me? And those numbers can be really high or really low. So how efficient am I? Leverage ratios, again, how much I'm leveraged or how little I'm leveraged from my assets to my debts. Profitability ratio, so how much on each dollar of sales that I have is resulting in profit. And that could be a cent, like every dollar in sales I get, I'm profiting 10 cents. Or every dollar of sales, I'm profiting 1 cent, whatever. So that's what profitability ratios show. Working capital is the difference between current assets and current liabilities. So in other words, how much money do I have left over after I pay all of my debts? If I was to have to pay them all off tomorrow, how much working capital do I actually have of my assets that I can use to build my business or expand my business or hire new people? Current ratio of working capital ratio is the comparison of a firm's current assets to current liabilities. So those are items you're going to want to know when it comes to determining your working capital. And then there's a thing called acid test or quick ratio, indicates the firm's ability to quickly liquidate assets to pay off its current debt. So how quick can I pay off my debt if I had to? And how quick can I turn my accounts receivable into cash? And so that's what you're getting into. Then you get into efficiency ratios. How quickly am I overturning my inventory? How quickly my credit accounts are being collected. Well, in other words, how well am I doing in getting my accounts receivable? Asset turnover ratio, tell the number of dollars in sales a firm generates from each dollar it has invested in assets. So all of these are just used to show the health of your business. And they're all really, really simple formulas for you to use. And I'm going to go to the book on this, because I think the book just gives you a great list of all of these ratios. So really all you need to do on these problems, and I'm not going to go over these either, but I'm just going to show you that if you just use the formula that they're asking for when you're solving the, I'm just going to go right to the formula page. But in your book, and I actually included this in your formula page that I've included in Canvas this week, but here they all are, right? So liquidity ratios, efficiency ratios, leveraging ratios, and profitability ratios. And so all you need to do is read the question. If it's asking for The current ratio, what is the current ratio on this? They're going to give you all the factors you need. They're going to give you the current assets. They're going to give you the current liabilities for the most part. Sometimes they'll give them to you separately. So you have to know what are the current assets and what are the current liabilities. There may be some additional numbers in there that are not needed for either one of those. But either way, you divide the current assets by current liabilities. That's going to give you your current ratio. And it's pretty simple that way. Same with all of these. So the only thing you need to be aware of when you're working out these kinds of problems is to make sure that the data that is given is all needed, because it may not all be needed. And it may not give you, may not give you your total liabilities, as it mentions here on the debt to asset ratios. And they might not give you all your total assets. They'll give all of them, but they won't give them to you totaled. So you have to add them all up and then get those total numbers and then divide them from one another. And that'll give you your debt to asset ratio. So that's pretty much it. I mean, you just use those formulas. There's not a whole lot for me to explain on that. You're just dividing on all of these. You're dividing, if you notice, certain factors except the first one, which is working capital. You're going to be minusing your current assets from your current liabilities. So you don't have questions on all of these. You only have questions on a couple of different ones when you're helping Sienna, as well as in the quiz, and as well as that'll be on the exam. So keep in mind that you're not going to have to do all of
question,
them.
yeah, Professor.
Say again?
I have a question, yeah, Professor.
Yes.
On the assignment question 7, you have asked us to find out, you've given net sales and cost of goods sold. So at that point, I can just find out the gross profit. That's what is mentioned right there. But you haven't given operating expenses. So how am I going to get my net profit? That figure is missing there.
Okay, let me look at it, because as you know, I'm editing those questions to make them.
The assignment for.
All right, so we'll look at this week's check-in assignment together. So, all right, so this one's fine. That one's fine. Those are both balance sheets, and all I'm asking you to do.
We cannot see your screens.
Oh, you can't see it?
Your screen is not shared. No.
Okay, now you can see it.
No.
Still not yet?
Yet. Okay. Yeah. Oh, yes.
Okay. So all you're doing on this first question is you're doing a vertical analysis, and you're doing it of your assets, and then you're doing it of your liabilities. So everything's going to be divided by the total here. So all you're going to be doing is entering in all the numbers and adding them up, and then taking the percentage of your assets. Actually, this one here, you're just making a financial statement. No, you're doing a vertical analysis. Sorry. So then you're going to do you're going to divide each of these factors by the whatever is the 100%. So the total assets or the total liabilities in this category, and then you're going to give me the percentage of percentage vertical analysis of each of those. And then here, again, you're doing the horizontal analysis. So you're just going to find the change. Now notice I put the newest year. I'm comparing that 2019 to 2021. So the original year is 2019. So you're going to divide everything, all the differences by 2019. And then that's going to be your percentage of change. And then is this the one you're talking about here? No?
We go to ratios question 5. All of the ratios say find the working capital and current ratio. All the ratios say that, which is not true. And yeah, the question 7 is what I'm talking about. It says it gives you net sales and cost of goods sold, but we can find out the gross profit, but since operating expenses are missing.
I'll look into that, because I think, yeah, I probably missed adding that on there. I'm basically creating this. I'm taking this problem out of the book and I'm putting it into Sienna's words, but then I had to actually create.
And that's what I was confused about, because it says gross profit margin.
Yeah, you're right. It needs to have the operating expenses. I apologize. But what I'm saying is I had to recreate these, and I literally had to create the table and type in each thing. So I just missed putting that data. So I'll put data right there. Sound good? And then you said there was another question on another problem?
Those I figured out. That asked you. And all these ratio questions need to be corrected. All of them say find the working capital and current ratio when they are.
Oh, you're right.
You're right.
My bad on those. I'll fix that too. Okay, thanks for pointing that out. I just cut and pasted them as I
Okay.
recreated them, and I added more columns. But you're right, I have to change those. So thanks for pointing that out. I'll fix that right now,
Mhm.
and then I'll re-upload it again.